Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. Very pleased to welcome to Forward Guidance Ben Harburg, Managing Partner at MSA Capital and Portfolio Manager at Core Values Alpha. We are going to be talking about all things China. Ben, great to meet you. Tell us a little bit about your background. How did you get into investing in China?
It's been a long time. So I came here as an intern for Motorola back in 2004 when China looked nothing like it does today, pre-2008 Olympics. I then returned in 2009 as a commodities trader and built what was at its time one of the largest commodity trading companies in Asia, selling raw materials into China, and had 4 offices in China. Was running around all over the country, meeting the power plants and refineries and everyone else. And then bit the bullet in 2015 and started a venture capital fund with some partners here in Beijing to invest in the technology boom that was just emerging at that time, and have really been here ever since. I moved to Beijing in 2015, and now 8-9 years later, I'm still here.
Over the past, let's say 4 years, China was actually early to emerge from the pandemic global recession. But I think probably at the beginning of 2021 was probably the peak in Chinese equity prices. And there's been a lot of bad news about China, specifically, in the U.S. In terms of its real estate market collapsing, in terms of just its growth model being dependent upon real estate, and the government kind of moving away from that. So I just want to ask, what has it been like as someone who's been living in China? I imagine it might be a different experience.
Yeah, it is very different. And I would say there's very few markets or trades globally, and certainly within the last few decades, that have the same amount of information arbitrage and information opacity. And so you get a very, very different narrative around the conditions on the ground in China when you're reading about it in New York or hearing about it in the news in London, relative to being here on the ground. And partially that's the Chinese to blame, and partially that's kind of Western media outlets and their, what narratives sell. So there's certainly been an easy narrative to kind of poke sticks at China, so to speak. But the Chinese did themselves no service by kicking a lot of foreign journalists out of the country, particularly over those kind of years around pre-COVID. And so you've had, for instance, the entire country of Australia for several years now has not had an accredited journalist on the ground here in China. So when you're reading about China news, which is a really important country for Australians, relative to their dependence on Chinese raw material exports or imports, they're reading about it from a journalist that's sitting in Seoul, Korea, or Tokyo. So it's a very different dynamic when you're on the ground here. And we think that means you can generate significant opportunities by being here and knowing the reality on the ground relative to what others are seeing. But the problem we face is that if global investors aren't convinced of the trajectory of the market and the stability of the market, fundamentals be damned, it's still going to be very challenging to get the kind of returns we expect.
So you said you started your venture capital business in China in 2015. I'm just looking at the value of newly built homes in China, and the value is down 4%, which is obviously not great. But the rate of change is actually slightly less negative than it was in 2015 or around there. So can you tell us the last time the Chinese property market was undergoing stress, let's put it that way, what was that like, and how did China reemerge from that? And do you think this time is going to be different? Is it going to have a kind of a different flavor?
So property, obviously a huge problem here. We have, you have a market here where for generations, people were told your store of wealth is in your home and in property. So that's where you should put it. And property prices are always going to go up. And then, there was this, let's call it a virtuous cycle at the time. We can call it a vicious cycle now, where regional governments wanted to, encourage large construction projects, often by private sector, as well as kind of, let's call them quasi-sovereign owned real estate development groups. And, by pushing that narrative around savings, and by getting people to buy, and then by pushing, more and more buildings, it created obvious clear benefits for them, right? So they had high employment, they had good economic growth numbers, but the simple reality was that they were overbuilding. We're way overbuilt here, not only in terms of domestic and commercial property, but also infrastructure. We have airports and train stations that are at a fraction of their capacity. This is the best infrastructure, I think, in the world, but it's not fully used. And so the net result of all that is that we ran off a cliff as that quasi Ponzi scheme of real estate developers that were building properties using advances from from sales, and then we're needing to build out the rest of the property, but we're running out of money because they couldn't finance the forward sales because people were starting to realize that there was overbuilding, that the value of their existing properties was going to go down, and so they weren't interested in those new properties, and that engine ran out of gas. The Chinese government has taken some measures to obviously take some of the air out of that bubble by stabilizing some of the largest property developers. One of the questions I get asked weekly is this a Lehman moment? And I don't know how many times I have to answer that, because definitively it's not. The market here is very different than the conditions you had in America. The banks have nowhere near the kind of NPLs that we were facing in the US. The amount of leverage is significantly lower. So it's, when someone takes a loan on their home here, it's kind of unrestricted liability up to the person. So they can't simply walk away from that property like people were doing in America when they realized that the home was no longer worth the amount they put in their down payment or whatever. And so you just don't have the same types of conditions that we were facing that led to an overall economic downturn. It certainly has created a very negative cycle around the Chinese economy, because now that individual consumers, retail consumers, aren't able to put their money into property and don't feel safe doing so, they're holding it back. So we've actually got this dam today of about $7 trillion of household savings that isn't being spent in the public equities or in real estate, because people are worried about declining property and equity values, as well as where their next paycheck might come from, because we're definitely in a downward economic cycle as well. But it's nowhere near the kind of explosive type of conditions that we faced in the West in 2008.
So it's an interesting comparison between 2008 burst of the U.S. residential property bubble and what China is going through now. I mean, I'll grant you, I did an interview in 2021. I actually thought it was a good interview, but we did title it like, "Is Evergrande China's Lehman moment?" And in terms of having a domino effect on the broad economy, I would say that has not happened. So I think your argument has been true. So you said the leverage in the Chinese banking system is lower, and the non-performing loans as a percentage of all assets, you said, did not reach where it was in the US in 2008. Yeah, tell us a little bit more about that. And then I should also frame for our viewers that I believe it's the case that a lot of the leverage in the Chinese financial system was on the developers, not on the purchasers of property. So it's not like the irresponsible lending was to people to buy the property. It was to the developers to develop the property.
That's right. And again, that's my point. So the developers were in this kind of Faustian bargain with the local governments and provinces, because they were in essence very good for business, right? They helped to stimulate growth numbers. They kept people employed. So from the outside, it looked really good, and they just kept building absent of demand. So to your point, people weren't being needled into taking mortgages. In fact, it's strange. Up until very recently, the Chinese were very restrictive of property rules around who could buy property. So, for instance, in Beijing, until very recently, you only could buy one property per household within certain parts of the city. And you had these really funny stories coming out of Shanghai where couples were getting divorced so that they both could buy a property and then secretly, getting remarried or whatever. And so they're taking down some of those barriers. They're now enabling people to buy more if they want to. It's obviously a little bit too little, too late. But ironically, it was the opposite of this kind of almost entrapment feeling that we witnessed in 2008. But the Chinese have always been much more conservative about their banking system. They were very proud of the way that they handled 2008. and also the Asian financial crisis that struck parts of Southeast Asia much harder than here. And so the net result of that was that they were much more strict when it came to giving loans to individuals, and again with that kind of recourse that was much more stringent as well. So the net result again is just simply that on a quantifiable basis, the numbers are nowhere near what we experienced in the West in 2008.
Where does the property situation stand today? I know Evergrande has fallen. Have there been any other real estate behemoths to fall? And then, where do things stand?
You'll continue to hear a steady trickle or even a mild, river of negative news points. So there are several other large property developers that are in bad shape, the likes of VanEck, VanKe, of Country Garden, and you'll hear them missing coupon payments or other. And the problem again with someone like I think that really took down Evergrande was not as much the fact that they were doing everything wrong on the property side. It was that they were also cross-collateralizing and had gotten involved in other business lines, and they were issuing debt to people, and they were missing those debt or those interest payments to retail consumers who had gotten some kind of a debt through one of their other side businesses. And that's when the Chinese government really cracked down, because if you can fault them for whatever you want, but the Chinese government are hugely sensitive to consumer interests and ensuring that people feel like they're not being treated unfairly by financial institutions, lenders, corporates. This is a people-first market in many ways. And so that's what took them down. But I think you'll continue to hear negative noise. But again, it will be nowhere near the scale of something that could drag down the economy. The real effect goes back to your original question about information, which is we hear these noises every day. We hear that it's going to be another Lehman moment in the Chinese market. We hear, traders are being told that everything is wrong in China because the property market is going to drag it downward. And that negative news cycle has created a hugely negative downward pressure on Chinese equities pricing, to the extent that today we have so many equities that we look at across they're listed in Hong Kong or even in the West, where they're trading today below the amount of cash they have on their balance sheet, and they're still growing at double digits annually, but are valued at a fraction of what they should be. And that goes all the way to the top. I mean, that even goes to a name like ByteDance or TikTok, who is valued at a fraction of what a close comp like Meta is. And so we see it across private and public equities, but particularly on the public side.
So, needless to say, you think some of the headlines about the Chinese real estate market dragging down the Chinese economy are overblown. And I just want to hone in. Is it that you think that the real estate issue is not that bad overall, or is it that you think that the impact of a Chinese real estate implosion is not going to be that large on the Chinese economy? And I guess I'll put a point on it. If I were to construct a basket of you of Chinese property bonds that yield 20% with VanEck and all the other things, with the risk that some could go bankrupt like Evergrande did, would you be a buyer of that basket, or would you sit out and politely decline?
I would not be a buyer. So we do not invest in the property space. And I'm not here to tell you that the property space is still investable and it's better than you think it is. And there might be opportunities to extract value from it on a distressed basis today. I think it is a secular trend that will see the decline of the property market as an important growth driver within China. And if you look at kind of the impact of different sectors on Chinese economic growth, already the property market had declined significantly, and it's been replaced by all the new technology, new growth, be it what we call green growth or the hardware manufacturing side of things, kind of greening energy, the greening of technology. What the World Economic Forum kind of all baskets within this kind of fourth industrial revolution. But no, I'm not a buyer of Chinese equities on the real estate side, but I do not think that the contagion there will undermine the forward trajectory of the overall economy. But it certainly has caused a decline in consumption, which affects different pieces of the economy. So it has affected other pieces of the economy, and more importantly, it affected the way global investors perceive China, and therefore causes us to be cautious around the entire equities market, because we want to make sure that we're staying clear of things that could be irrationally depressed on the back of negative noise around the real estate space.
What's an example of something that could get irrationally depressed?
Anything. So, I mean, where even the blue chip technology stocks today are still trading, someone like Tencent, there's no rational basis for Tencent's valuation today, other than people have a overall macro malaise, negative news story around China, rooted largely in real estate, also has to do with a lot of the macroeconomic or the geopolitical challenges that China is facing relative to the US, noise around sanctions, noise around increasing tariffs, noise around potential conflict in the South China Sea or Taiwan. So all of those kind of are mixed together in a vicious cycle, perfect storm of bad news. But I think that people most key off the real estate side because they understand it. And it's the easiest to kind of comprehend on a dollars and cents basis how that would affect the Chinese economy.
And how would you say Beijing, where you are right now, the Chinese government is, what is the Chinese government's take on the current state of the Chinese economy? And are they going to do economic stimulus?
They are massively concerned about the state of the Chinese economy. I think they were concerned too late on it. So there was this kind of emperor has no clothes period from end of 2021, early 2022 until early 2023, and that's where we really lost it. That's where we lost control of the global narrative around China. Because to your point, up until that moment, it was perceived that China had done a good job of managing COVID internally. But once the West started reopening and China was still locked down, and then you had those kind of other negative news stories layering on. So issues around Alibaba and the aborted IPO of Ant Financial, the DiDi being forced to delist after listing in the U.S. All of these kind of negative narratives started stacking, and that's when and then I think the real crash came October 2022. When we had, Xi was, received his next term, his reappointment, and during that conference, they announced the new Politburo, and I think there was a kind of a global perception that a lot of these new Politburo members were loyalists rather than technocrats, rather than meritocratic folks that would help drive forward economic growth. And off the back of that news, we saw a lot of the lowest of lows that we've seen in many of our stocks. But I think it's just a narrative that China had, in the headlines for that year plus, that they favored stability and internal control over economic growth. And the problem that China's market faces today is you've got, companies like Nvidia and others in the New York Stock Exchange just ripping. So why do I need to deal with geopolitical uncertainty and internal regulatory question marks and potential real estate bubbles and all these kind of ifs, if there's just this kind of growth in the U.S. side that makes up for all of it? There's no reason to deal with any other of any of these headaches. So I think that 2022-2023 period was where they really lost track of the narrative, and it's only recently, I think within the last 24 months, that it's been all engines go, foot on the gas to try to make global businesses and even just visitors understand that China is very open for business. They've even just in the last week issued a new visa free for, I don't think it's like 448 hours or 188 hours, visa free for most people around the world to come to China. They're issuing visas, throwing out visas like candy to people. They're doing everything they possibly can. There are delegations coming out from China every day to the four corners of the world, trying to recruit foreign capital to come back to the market. Because the biggest challenge we have is all that FDI outflow. So they are a foot on the gas. But my worry is it's a little too late, or that at the very least it's going to take several years to rebuild that trust that was broken.
And so I think Chinese GDP in terms of growth bottomed in 2022. And since then, growth has been hovering about maybe a little bit above 5%, which in nominal terms, it's higher than our viewers in America, where, in Europe, where we have an inflation might suggest, because China is actually experiencing a deflation. how, not mild deflation not like 3% deflation, but less than 1% deflation with prices going down. Deflation, a lot of economists see it as something that can build and cause recessions, because if prices are going down, you should just hold on to cash and not spend money. And then prices go down even further, and it can exacerbate. The most prolific example of that would be the Great Depression of the 1930s. Does the Chinese government or the People's Bank of China, do they have an inflation target in the same way the Federal Reserve has a target of 2% inflation? Are they displeased that the economy is experiencing deflation, that prices are going down?
I don't hear as much conversation around the deflation narrative here, and actually in many ways it goes back to that information arbitrage where the numbers look like they're down, but that's and the quick reaction of Western readers or investors is that's because no one's buying. The reality is they're buying, but the price points are much lower, and so you just don't see it showing up in the numbers on kind of a aggregate basis. And this trend has been going on in China for quite a while, as the economic growth engine slowed, and to your point, it's still a lot higher than in the West, right? So 5% is nothing to sniff at, especially for an economy of this scale. This isn't like we're Singapore or something like that. So for an economy of our scale to still be growing at 5% is great, but because of that downward trend, we've seen wages flat, even declining. We've seen bonuses being cut, and so people are still spending, but they're spending at much cheaper prices, which is great as a consumer around here. But it's part of a larger cycle, which we call consumption downgrade, where people were literally buying products and services that were first domestic. So this hurts global brands. So for instance, Nike came out with their earnings a couple of days ago. Stock cratered off the back of it. And they blamed a few things, but one of the things they blamed was China. And they just said that China wasn't consuming the way it was. This is an easy narrative, and a lot of Western companies use China's decline as a way to excuse their overall poor performance. But again, when you come on the ground here in China, what you see is not that people aren't buying sports equipment; they're just not buying Nike. They're buying Anta. They're buying other domestically developed brands here who have worked better with local celebrity athletes like Eileen Gu. They're working with, to make more culturally appropriate or, tasteful clothing, whatever it is. But, there's this localization. So Starbucks is losing out to Luckin Coffee and Manor Coffee. And of course, any of the American or Western fast fashion companies like Uniqlo, Zara, et cetera, are just being absolutely slaughtered by Shein and Temu and Cider and others. So there's kind of a reshoring of brand and consumer behavior, which affects that. So I don't think the Chinese are as concerned about the inflation picture. They are very much concerned about the FDI picture around the public equities, and they're very much concerned around the growth numbers. What they'll tell you today is there's huge pent-up growth in China, which just hasn't been released. So for instance, we're in the process of an urbanization drive to bring people from fifth tier, sixth tier cities into the first and second tier cities. That alone is going to generate something around 300 million new consumers in the Chinese market. So we're talking about an America in terms of consumers, or two Indonesias of new consumers that are just coming on board into new cities. Chinese companies have become very efficient. And now the real drive, and I was keynoting a conference about it today here in Beijing, is to go outward and to take over global markets. And that's where you're really seeing the pushback from the Americans as Chinese products come head to head with global products. Because what they're going to start doing is, and I remember meeting with Zhang Yimin during the early days of ByteDance, and even then he told me, we're going to make 50% of our revenue from the West, or from outside of China. No way. I mean, never in your wildest dreams would a Chinese software business make half its revenue from outside of China. And here we are, and it's obviously achieved more than that, but has also become a lightning rod geopolitically. And so we can get more into it later, but our belief is that what's going to help the Chinese economy stabilize in this environment is selling outbound into all the other markets and bringing that revenue home.
Forward Guidance is brought to you by VanEck. The VanEck Morningstar Wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task: Buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar-wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks. Let's get back to the interview. So Ben, FDI is foreign direct investment. So U.S. wants to bring the foreign money back into China. But just on the retail sales point, okay, so people are not buying Gucci as much, and so they're buying a Chinese equivalent, a Chinese luxury brand, and so the Gucci CEO on the earnings call is complaining, and you see that as an excuse. But in the data of the retail sales, consumer spending in China is well below trend. If you just drew the line from 2020, industrial production is up, but spending is down, whereas in the U.S. spending is way above trend. So is it fair to say that the consumer spending in China would be weak? And if you think that's going to change, why?
It is definitely weak. And again, it comes back to people, the economy has been rough. People are losing their jobs. They're losing value of their properties, losing value in their public equities. And so they're spending a lot less because they're worried about when their next paycheck will come from. So again, they'll buy a Luckin coffee rather than Starbucks. So the numbers are going to look lower because the price point is much lower for those products on an aggregate dollar basis. But they're afraid to spend. And that's why I say there's this $7 trillion of household savings sitting as a dam kind of backed up, waiting for the market to feel safe again for them to reemerge. So for us, we think that's a great opportunity. We think that when you've got that amount of savings, it's not that there's no money. It means there's kind of infinite dry powder, but the conditions need to be met for them to feel like they can come back to the market. To your previous question, I don't think that there's a major stimulus package coming. This is not in the DNA of the party. If they do it, they'll do it quietly. And you've been seeing they're adjusting interest rates. They're buying up ETFs. They are stabilizing banks. They're doing all kinds of different things domestically, quietly. But it's almost a point of pride for them not to come out with some kind of a cash handout type stimulus like we had in the United States that would create artificial or unnecessary inflation. So that's why I say they're not as concerned about that inflation number. So I think those people will slowly edge back into the market once the labor market stabilizes, once property prices stabilize. And we're seeing the first inklings of that. So for instance, they ran a pilot project over the last few months in Shanghai, doing what I mentioned, opening up the buyer base, allowing people who had historically not been able to buy properties to buy them, lowering interest rates, just like little tweaks to the levers, and actually improved property purchases for the first time in a few months. So there are some of these pilot projects that are proving that they can do that on the real estate side. Public equities kind of felt like we've hit kind of a lower bound. It doesn't feel like it's going to drop significantly, but we're still waiting to see kind of a healthy recovery. So I think once we see more of that, and our view as a firm is we load up on Chinese equities now because we think we're in a counter-cyclical environment where the U.S. is running out of steam. And you've got, like you saw a few weeks ago, this daily drop of 500 billion in Nvidia. That meme of Taylor Swift and Nvidia kind of carrying the American economy would cause me to worry about its overall sustainability at these types of levels. And so I believe that Chinese and American equities are now decoupled, and we're sitting at different places of kind of the economic cycle. And I think China is well positioned once we see a faltering in the West. And, a lot of the Chinese, to that point about FDI, a lot of the capital that was historically going to China has been been redirected either back to the US or to Japan or to India. And I think it's misguided. I think India is a bit of a mirage, actually. I think some of these other, what are kind of markets du jour are not all that they're cooked up to be, for many structural reasons we can get into. And so I think that money's going to start slowly to come back to China. It'll probably come first back to the blue chips, which is why we've loaded up our ETF on them. But I think it might still take half a year, but I think it'll come, and I think we'll see a nice rebound.
Right. So your ETF is Core Values Alpha Greater China ETF, CGRO. Which was started recently. By the way, congratulations on not starting it, starting it after the collapse. So, good timing. What did you said India is a little bit of a mirage. Why?
As someone who has worked in India and done business in India since 2008, I can tell you that it is far more opaque, far more corrupt than anyone. It's kind of favored, particularly at American governmental levels today, largely because it is a democracy and it sits as an adversary to China, right? Because of the kind of battles that the two have faced on along the border in along the Himalaya mountains. There's a Kashmir region. There's this feeling that that it's an ally, let's say, in the Cold War on China. India is with the United States, and so you get nonstop positive news stories around India. But the reality is, it's a really challenging market. It's still very inefficient. It's still very corrupt. It's controlled by just a few big conglomerates and families. A lot of that wealth isn't trickling down. The average revenue per user, the average spend per user is still very low. And it's just a very challenging market to navigate and a very inefficient one in which to do business. China is far more efficient to do business and actually in many ways far less corrupt and far less opaque. You have to be here on the ground, but just ask any of the large American corporates that make their bread here, like Tesla, Apple, Starbucks. They've all been printing money here, and it's interesting to me actually that Elon Musk is able to walk this fine line of being so pro-American and kind of this flag-waving guy who's taking all the DoD and the NASA contracts on SpaceX, and yet comes to China very frequently. He's either here virtually or in person this weekend for the AI summit that's going on in Shanghai. He's constantly here, constantly pumping up the Chinese economy, constantly lobbying government officials here, and is doing a great job of managing, I think, both sides of the Pacific. But all that's to say, I think that the kind of structural weakness in India is far greater than anyone anticipates, and we're just kind of sleepwalking into it because it's a nice, supposedly capitalist democratic narrative into which to redirect capital out of other parts of Asia.
So you said that China is a lot less opaque than India. As someone who has, as an amateur, read some Chinese SEC filings or the equivalent investor presentations, I would say that some of those tend to be opaque. I'm curious if you agree with me on that, particularly with the Cayman VIE structure. But what you're saying, as someone who's actually on the ground, to do business in China is easier than India, less opaque.
Yeah, you're referring to kind of what are in the S1s and the filings around a lot of the Chinese corporates. And they need to do a better job of that. And the Chinese government is also very much on that today. And we had, there was another period, which was one of those other worries that I stacked on all the other ones, which was there was the threat of delisting from the SEC and the Public Accounting Oversight Board, specifically because of the issue that you mentioned around, shoddy accounting practices and things like that amongst the Chinese corporates that were listed on U.S. exchanges. Apparently, the SEC and those fears were assuaged because they pulled back that threat. The investigators spent a significant time in Hong Kong and other geographies around China, understanding the picture, and came away appeased. But it's certainly clear that a lot of Chinese corporates are terrible at investor relations, terrible at managing foreign stakeholder issues. We are constantly shocked by how poorly done. And if I were in another lifetime to create a new business line, it might be to do investor relations for Chinese corporates, because they kind of undersell themselves to Western investors by not having the right people to deliver their message. So I think that's an issue, but I don't think it's an intentional, shrouding of the truth or reality around the business. In India, you face kind of true corruption. So that, for instance, as a commodities trader, I did a business with a guy named Gautam Adani, who is the closest ally of the current, reinstalled, president of India, Prime Minister of India. That guy's crooked, and it came out that the whole thing was as crooked as it could be. I mean, his businesses had a couple shareholders, and it was all offshore. It was a web of and even your friends at Iceberg Research or at Muddy Waters will tell you that these corporate structures in India are just an absolute mess. So yes, every now and again in China, we have these fraud cases like Luckin, which, by the way, is now an incredible business and is thriving again. Or I saw a Muddy Waters or one of the Citron, I don't remember which one, report on some Chinese company that had kind of fake Disneyland kind of knockoff theme parks or whatever. So you have these, you have these narratives. That's fine, but these are not like the Adani story would be the equivalent of Alibaba in China being a fraud, right?
It's a huge company.
Yeah, I mean, this is the Alibaba of it. I mean, the only one bigger is maybe Tata and Reliance. So so when you've got that scale of corruption and opacity going on, we've known this. I mean, again, any one of us who's been doing business in India since 2010 will tell you this is what it's like every day there on the ground. So it's kind of funny to see the Americans kind of walking in there acting like this is the new market without really truly understanding the reality on the ground.
Right. That Adani report came from Hindenburg, activist short seller. You also mentioned Muddy Waters. I wasn't going to bring this up, but because you mentioned Muddy Waters, they did a short report a few years back about Beike Holdings, a real estate company. And I noticed that is in your ETF. Do you have a view on sort of the bear case on Ke Holdings and why you disagree with it?
If it isn't, it's interesting. I'll have to go back and check that one. It should be one of the smaller ones. But Beike is not a real estate company as much as it's a marketplace. So it's not taking ownership of the properties themselves. I'm trying to, like, the Western equivalent would be like maybe Zillow or something like that. So it's a marketplace, and when there's churn and there's a lot going through the system, then you'd see volume coming through it. And so we think that there's still some interesting opportunities within it, but it's not a real estate company per se.
Got it. Just final question about the Chinese economy before we turn exclusively to stocks is you said because real estate prices have declined, that may have weighed on consumer sentiment, weighed on consumer spending. And that makes me think of something that we've covered a lot on this program, Forward Guidance, which is the wealth effect. When stocks go up, when real estate goes up, people who own those assets feel good and they spend more money. That can be a virtuous cycle, but then a vicious cycle when asset prices decline. So I think of one pillar of the Chinese economy as asset prices and specifically real estate, and that is not going so well. But then, of course, the other is the labor market. That's how people get money. I have seen like the Chinese unemployment rates go. It was about 4%, and then it shot up in 2018, and now it's at 5%, which to me doesn't sound terribly high. In the U.S., it's 4%, which is quite low. And then I also know the youth unemployment rate stopped being reported, but some people think that was just data. So how do you, as an economic observer of China, observe the labor market? I mean, maybe it's the unemployment rate is a secondary statistic and there's something else. But number one, what is the strength of the labor market or weakness in the labor market in China? And number two, what data do you point to make that observation?
So you've seen the same numbers I have. It was high double digit. We're talking like 20%, 30% youth unemployment that you mentioned at the point when they stopped reporting it, which I think was a really bad move. I mean, I don't know why. And I met with Xi Jinping last November, and I delivered to him the same message that I deliver publicly, which is you need to do a better job with all of your data and all of your policy measures of foreshadowing, forecasting, and explaining to people why you're doing this. And there's this odd kind of petulance amongst the Chinese, and I don't know if it grows out of one-child policy or what kind of cultural driver it is, but they have this perception that they don't need to explain themselves to the world. The world should kind of understand why they're doing what they're doing. And so, for instance, even the delisting of DiDi, in my mind, actually, they were justified in doing it. DiDi went public without having a correct set of operating licenses here in China, and there was a whole bunch of different gray zones where they weren't properly recording and delineating between revenue and commissions and take rate. And I don't know how much you looked into there, but if they'd gone public in Hong Kong versus the West, actually their share price would have been significantly lower because they wouldn't have been able to use a lot of the money that they were recording as revenue, because it was kind of like rides, kind of gross merchandising value. It wasn't actual revenue for the business. So I say this all to say they were a bad actor. They rushed to go public in New York along the same lines as someone like one of these WikiLeaks guys, like Julian Assange, running to the Ecuadorian embassy in London, thinking that by being inside of the embassy, he would be safe. And they thought by running to the American exchange, they would be safe from the regulators and safe from intervention. But obviously the Chinese didn't care, and they still cracked down and essentially forced a delisting. I think they did so for correct grounds. They never explained why. They never forecasted it. They never said these are all the different rules they broke. They just kind of went and did it. And they did so also kind of thinking that the world would interpret it, that they were on the right side of the argument, and therefore wouldn't have kind of the ripple effects that they did. In reality, what happened was the whole world looked at the DiDi case as kind of the hallmark for doing business in China. And we saw huge stock market corrections off the back of that. And it kind of caught the Chinese regulators off guard. And they were like, what's going on? How is this happening? We thought we were doing the right thing. Why is everyone acting like this is, the benchmark for the entire market? And so they do that over and over. Back to your question, though, on the labor side, it is not a healthy labor market. I would never portend that it is. We're seeing, again, a lot of layoffs around the market. We're seeing salary decreases. We're seeing people being forced to give back their bonuses. But it's all part of the same vicious cycle, which is stock prices are going down. Companies have less equity, have less kind of capital to spend on growth. And so everyone is kind of battening down the hatches right now. To your point, the growth picture is still not dire at all. And the Chinese government always has the ability to kind of provide for other employment opportunities by bringing people into civil jobs, kind of government-created jobs. The government here has a whole web of what we call SOEs, sovereign-owned enterprises that operate across every business line you can imagine, from operating restaurants to oil refineries and financial institutions. So they have the ability to kind of play with those levers and bring people back and forth into the labor market. But it is not a healthy labor market, but it's one that I think will be positively impacted as equity prices improve and the real estate picture stabilizes.
Got interesting. I'm somewhat surprised to hear your view of the Chinese labor. I mean, the stated unemployment rate from 2022 has gone down from 6.1% to 5.0%. But you think it's still quite bad?
I'm just telling you what I'm feeling on the ground here as we talk with large enterprises. So again, on an overall quantitative basis and an aggregate basis, perhaps you're not seeing as many jobs being shed in manufacturing and a lot of the kind of long tail businesses. But when we talk to kind of the blue chip, white collar employers here amongst the banks, financial institutions, technology companies, you're seeing more layoffs. But it's not overwhelming, and it's not something that, where you have people in the street picketing because they're unemployed and not able to eat. It's still it's a stable market.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10. Stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Van Spencer's going to be there. Jim Bianco's going to be there. Jan VanEck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode. Got it. All right. So now let's turn to the investment side. If people can't tell already, you are a bull on China secularly, but it sounds like you think that the valuations are attractive now. What kind of price to earnings ratios are you seeing, and how attractive are they historically?
Well, so I'd qualify that. I'm not a China bull across the board, and I'm certainly not a China economy apologist or a cheerleader. I think that there are many flaws within the Chinese growth model, within the Chinese economy, within many Chinese corporates. My job isn't to be a Chinese market bull. My job is to selectively pick a few names that I think are going to do really well and that are mispriced today and that are primed for significant growth, even on a purely fundamentals basis, if there's no improvement in kind of all these other levers around the economy, but if there is, that we think are going to be set to rocket. And so for us, we focus on a few key trends rather than, because to your question, and I'm not trying to avoid it, price to earnings, it's kind of gone out the window, and I can't use a quantitative approach to evaluating Chinese stocks today, because I've got to look at each one individually, because on a fundamentals basis, they don't make sense. And I can't comp them against a Western company. I can't comp them against a previous valuation. I have to look at the specific business model of the company and ascertain, does it fit within one of my thesis around something as broad as, if money does start to trickle back into the economy, then these blue chips will see improvement, or something as niche as these are the key sectors within China that we think, come hell or high water, are going to continue to grow. So for us, the types of sectors that we like, for instance, are that domestic brands I mentioned. So that brand, so instead of Procter & Gamble or a French whatever perfume brand, the Chinese are buying companies like Proya, which is a local cosmetics company. Again, rather than Nike or North Face, they're buying Anta, or they're buying other local brands that we have in our ETF. Rather than buying Starbucks, they're buying Luckin Coffee. So we've been investing and putting capital in those domestic brands. So that's one vertical we love. Another vertical we love is that kind of fully integrated supply chain. So the BYDs of the world, where in spite of all the negative noise you hear around sanction in Europe, in the United States, or blacklist, these cars are flying off the shelves, and global consumers are shocked by their quality relative and relative price point relative to other Western comps, particularly the likes of Tesla. We love the China going global narrative, and it's one that I think is just in its early innings. So if you look at the American App Store today, and maybe it changed over the last few weeks, but it was 4 of the top 5 apps in the American App Store were Chinese built. So you had CapCut, which is from from TikTok. You have TikTok, you have Temu, and you have Shein, right? So China's now dominating in the social media short form video space. They're dominating now in the e-commerce kind of fast fashion space, even to the extent that just in the last few days, Amazon announced that they're building a replica to try to compete with Shein and Temu. So Temu obviously being a brand of Pinduoduo, which is one of our biggest holdings in the ETF. So we're looking for those types of narratives, and then of course the traditional blue chip names with some caveats. So we love Tencent. We still think Alibaba has a long way to go, particularly as it becomes more of a cloud services business than just a purely e-commerce company. We love how Tencent is shifting away from being just a purely consumer-facing gaming-oriented business to one that's making more money on enterprise sales, advertisements, cloud than its traditional business line. So we're looking at things like that. So those are some of the areas that we love, fundamentals aside.
So macro fundamentals aside, in other words, you're bullish on these particular names because you've done the work on these individual names, not the basket. But would you say valuation plays in reason why you are bullish? I mean, Tencent is something like 15 times earnings, which I'm sure is in a very, very cheap percentile relative to its history. Is that part of the reason?
Oh, absolutely. I mean, so when we deconstruct someone like a Tencent, we're not just looking at those low teens. The reality is if you strip out their, the numbers are even crazier if you strip out their investment holdings. As Tencent were investors in Neo, they're investors in Meituan, they're investors in Pinduoduo, they're investors in just about every one of the leading Chinese technology companies. They're better investors than I think any venture or growth fund could ever claim to be. And so we strip out, we do look at the composite parts of each one of these businesses. We think they're undervalued. And if someone does, I mean, there's a few times, for instance, where we de-risked off of a name like Pinduoduo because it, in spite of all of the negative noise, jumped up. And so we're moving in and out of these positions too, as we think that they cross some of the barriers that we've placed for them on the price to earnings or price to revenue.
Can you tell us a little bit more about Chinese production and just how cheap they can make it? I mean, BYD, one of your holdings, owned by the late and great Charlie Munger, is creating an electric vehicle that's $15,000. Can you just speak to just how cheap that is?
It's crazy. We also have a home, and we have our kind of HQ2 in Abu Dhabi. And I was at a conference last week where they showed a chart that showed that in 2018, and I forget about just electric vehicles. Let's talk about just Chinese cars, combustion engines as well. In 2018, the amount of Chinese cars sold in the Middle East was 1%, or they made up 1% of the Middle Eastern car market in terms of place of origin. Today, they're about 22%. So in 4 or 5 years, I think that's right. And even I think it was even later, it might have even been 2019 or 2020. So they've basically grown to be 20% of the Middle East car market in a very short period of time. And what you have today is not just BYDs. Let's talk about combustion engine, like a car like Jetour, Jetour. These guys make a almost exact replica Range Rover Defender. The Range Rover Defender in the UAE right now retails at about $80,000. Their car sells for $18,000, and it is on par or better on spec. And even affluent Emiratis who have plenty of discretionary income, no reason to scrimp and save. They're not facing the same types of downward economic trends a lot of us are in the rest of the world. They're buying the Jetour over the Range Rover. And whenever I talk to people in the Middle East about their experience looking at Chinese cars, they're just shocked by the quality of them. I'm someone that owns both a NIO, and we were early on our venture side. We were early investors in NIO, one of the largest investors in the first kind of institutional funding round there. And then I also have a Tesla. The quality of the NIO to the Tesla is vastly superior.
Really?
The amount of leg room, the quality of the interior, not feeling like I'm in a creaky kind of plastic car. It is a huge deviation in terms of quality, and it's not what you expected. And we're seeing the Chinese do this across verticals. It's not just in electric vehicles where kind of there's been probably the most noise. It's also in spaces like handsets, where China is dominating handsets. I mean, Apple has priced itself out of the emerging consumer world years ago, right? So today, if you're in Africa, no one owns an Apple. They own Oppo, Vivo, Xiaomi, and then another company called Transsion, which many Americans have never heard of. They make a phone called Techno, which just dominates both the smart and feature phone markets in Africa. It's another name that's in our portfolio. So there are so many hardware, and the Chinese are doing it across the world, and offering products that are on par or better spec than their Western or American competitor at a fifth to a tenth of the price. And so I think these guys are going to do phenomenally well, even if there are sanctions, which are anticipated to come. And ironically, you're seeing it's the German automotive industry that's pushing back the hardest against sanctions, because they were all smart enough to come to China and form JVs with local OEMs here in China, the likes of Audi and BMW and even Porsche. And so they're the ones that are the most angered by these tariffs, not the consumers. And it's actually markets. I was reading in a report about this morning. It's the countries that don't make cars that are the most supportive of the tariffs. It's the Spanish. It's the French, who have maybe not done as many of these bilateral partnerships here in China. And some of the Italians, again, who have fewer kind of, let's call them low end cars that they're selling into the Chinese market. So ironically, but you're going to see this across the world. So you're going to see the Chinese just wiping the floor with people across hardware, be it cars, handsets, air conditioners, or cookers. And then you're going to see it across the software space, because China evolved their technology at a time just when we were starting to adopt mobile first technology. And so the way we describe it is China's going to win those, that native technology user, because they're building products that are exactly kind of in line with the tastes of those emerging consumers, those kids like our kids that are born never having looked at a magazine and always kind of trying to expand the pictures on a physical magazine because they're only accustomed to an iPad. That consumer.
How high do you think that the tariffs in Europe and the US will get against China? And I mean, you can make an argument about, well, economically, it doesn't make sense, or the Chinese, the German automakers are, have partnered in a joint venture with the Chinese original equipment manufacturers, OEMs. But I would argue that the reality is, if politically, people, politicians are going to pass tariffs and it's popular, it's probably going to happen regardless of if it not makes economic sense. I mean, Trump, if he's reelected president, definitely would enact quite harsh tariffs. Biden also has enacted tariffs against China. How big of a threat is this to the notion that China is just going to dominate an export manufacturer of high value goods?
So the tariffs are inevitable. We heard more tariffs coming through this week. I think they'd already been priced into a lot of the companies, so that you didn't see a huge correction on the stock market. The political side of things is very interesting. And you mentioned Trump. We listen for anything that's China related that comes out of the U.S. election. And we obviously expected a fair degree of China bashing going into the election cycle, with each political party trying to kind of outdo the other on who was tougher on China. And you had during the debate last week, you heard Trump say that China wants Biden as the president because he's shaky and he's soft and he's easier going. Ironically, that's not true. That he was playing coy with that statement. The reality is the Chinese would much prefer Trump, as would most of the people in most of the markets that I deal with. So the Middle East would prefer Trump. I'm not even sure if India wouldn't necessarily prefer Trump. The Europeans certainly won't, but the Chinese do. And the Chinese would prefer Trump because he's transactional, and because he's not concerned with a lot of the intractable issues that the Democrat administrations typically are when it comes to China, around human rights and Xinjiang and a lot of those buzzwords that you hear mentioned a lot. They're not part of Trump's vocabulary. And last time around, I think Trump did try to do a deal with the Chinese that was in many ways in the best interest of American businesses and consumers. And at the time that he tried to do it, China was kind of reaching its economic apex in recent memory, right? So that was when we reached some of the highest levels of foreign capital coming into China. Equities were at some of their highest levels. China was announcing these broad-scale projects like China 2025 and Made in China, and the Belt and Road Initiative and other things like that. And so I think they were much less willing to come to the negotiating table and kowtow to the demands of the Trump negotiators. This time around, I think they are much more humbled and weakened relative to their, and had a lot of their vulnerabilities exposed. So actually, our bet is if Trump is elected president, you should see a significant spike in Chinese equities, which goes back to why we're bullish, and with our kind of basket, our very specific basket in this environment. We think that the Trump presidency would actually have a potential for a binarily, vastly improved outcome with the Chinese. If it's another 4 years of Biden, it's going to be very flat. Same dynamic, maybe continued encroachment in terms of more sanctions and more restrictions. So nothing good, all kind of negative. But with Trump, actually, the Chinese could do a deal and see significant improvements because they know what he likes. They know he likes to open factories and show he's brought jobs home, and they can find ways to make that happen for him. I think their biggest frustration with the current Biden administration is they feel almost powerless. There's nothing they can do. There's nothing they can offer to Biden that will improve the current economic picture, or the way that the Americans are managing them, be it in terms of the sanctions on Chinese companies, restrictions on technology coming into China. I think Trump will certainly be concerned with America winning and ensuring that we're extending our advantage and not giving over our IP to the Chinese and our best researchers over the Chinese. But so all that's to say, I think that we're in an interesting environment now where we could see some binary outcomes on the political front. But yeah, the sanctions will continue unabated until that time.
But you think that the Chinese manufacturers are just so competitive that they will succeed despite that? I mean, do you think we're going to see BYD cars, NIO cars in America soon?
It's possible. I mean, NIO have already started their encroachment in towards the West. So they've opened up showrooms in Norway. They've opened up in Germany. So they're kind of making their way towards the U.S. what you'll probably get is you'll get like a NIO or a BYD car that's largely assembled in, say, Mexico. I mean, you've seen this huge transplant now of Chinese manufacturing to Mexico. So I'd be bullish on the Mexican economy right now as well as a result of that displacement. But I think ultimately, if you have kind of a meeting of minds, the Chinese could also open factories in the U.S. and start selling these things there. But the simple, just as we're seeing the Taiwanese having to come to America and go to, Arizona and open up chip fabs there, as opposed to in Taiwan and importing all of their, domestic foreign labor into the domestic market in the United States. So no, I think it's possible. And their price point and their quality is so great, and their price point is so low that they can stomach a lot of tariffs. And eventually the consumers will revolt, because consumers want best quality and price, and especially in an inflationary environment like the West, particularly the United States. If there's a foreign car that's at a fifth or a tenth of the price of a domestic one, I think you'll start to see more gravitational pull towards those alternatives.
What about Chinese regulation, and in particular, have you looked at Chinese financial technology companies?
We have never invested in the Chinese fintech space, and I was actually doing an article with The Economist yesterday, and the Xi Jinping himself raised this issue of why are there not more unicorns being minted in China today, and there's all kinds of structural and evolutionary reasons for that. But in one vertical, like the one you bring up, fintech, we've essentially lived under a duopoly for the last couple decades between Tencent and Alibaba. And there's never been any fintech to invest in, to speak of, because I do all of my financial services activities that are at least technology and kind of mobile based through my phone, through my Tencent WeChat Pay app, or through the Alipay app. And the Alipay, if you've seen the kind of web of services it provides, you can do everything. So you think of any American technology company, be it buy now, pay later, consumer lending, point of sale lending, education financing, money transfer, whatever it is, all of these are already included within the Tencent and particularly in the Alipay app. And now China is actually going through a process of and this was part of the reason why the Ant Financial IPO was scuttled, and I believe it should have been. By the way, this is, we don't hold China to the same standards that we do Western companies. These Chinese companies that were under fire from the Chinese regulators are under fire because they were unnatural monopolies. And the same type of antitrust measures that are being taken against companies like Apple, Google, Meta, Microsoft every day, and particularly European regulatory markets, are happening in China on a belated basis. Actually, up until 2020, 2021 in China, we were living in kind of a laissez-faire law of the jungle environment. It was nothing like you expect from this authoritarian communist kind of command and control economy. People were doing whatever they wanted. And so you had all kinds of unnatural monopolies. I mean, it was America during the age of Standard Oil. And so they're breaking apart the Standard Oil of China right now, which is Alibaba and to some degree Tencent. And they should do so, because it killed all the competition and it made it so the consumers had essentially zero choice. And so in the financial services space, I think you're going to start to see an unlocking of opportunities. We just saw yesterday one of the Alibaba companies is being forced to spin off out of Ant Financial. I think eventually Ant Financial will list something, but it'll be a far smaller, simpler platform than it was, with a lot of those things carved off and a lot of licenses taken away from it. And I think that's, by Western standards, the right thing to do. But it meant that we had nothing to invest in on the fintech side.
Got it. And I believe Tencent and Ant Financial are not banks. They are the pipelines to banks, but the institutions making the loans are banks. Given that so much of bank credit over the past 2 decades has gone to real estate development, do you think that the government will take a look fondly upon the growth in consumer credit away from real estate credit?
It should. And, again, we're the opposite. To your point about Americans are spending above their means and, this is, again, why I'm worried about the state of the American economy, looking at student debt, looking at credit card debt, looking at, any form of household debt. America is not a healthy economy by any means. I mean, I don't know why I have to be kind of the Chicken Little, right? And people think we're crazy that we would be putting money into China right now, that in many ways, in my opinion, has a lot more negative noise around it, but is more fundamentally sound. The American state of the American economy is scary. So to that point, there wasn't very much consumer credit or consumer debt here. In fact, when someone has a situation in China, and I hear about it like once a month, where, a taxi driver took out a loan on top of a loan and couldn't repay it. And so eventually there was some murder-suicide or something like that. I mean, that's headline news in China when something like that happens, someone who's stressed out because of debt. And the Chinese government were actively taking measures to curb consumer debt a few years ago when they cut down on what was highly predatory peer-to-peer lending space in China. This is where we were giving people very high double-digit interest rate or even triple-digit interest rates on micro loans. And they saw that as predatory, anti-consumer health. So they cracked down on it. Just, by the way, the same reason why they cracked down on the tutoring and kind of education technology space. It was a nasty, nasty space. But they did that for consumer protection. There's huge opportunity to be unlocked in consumer spending. We don't have buy now, pay later here in the Middle East, in China. One of our best investments in the Middle East is now the leader in buy now, pay later in the Middle East. Klarna on these companies, they become Gen Z's credit card, so to speak. We don't have that here in China. So there's much less consumer debt, which means we're a healthier market, and there's more spending that can be unlocked through opening that up.
Got it. So your ETF is obviously investing in publicly traded companies, but your MSA Capital, where you're managing partner at, is that exclusively VC and private markets, or do you do stock publicly traded securities there too?
It's just private. So these are complementary strategies. So on the MSA side in China, we have venture funds and we have growth funds. So we're investing kind of from Series C to B on the venture side, B to pre-IPO on the growth side, and then ostensibly the public equity fund would take over in names that aren't in our private portfolio. So we are not able to overlap and have names that are coming out of the private portfolio, but we have huge information, and usually we're distributing our shares 6 months after lockup on the private side. So then we come back into these companies once we're out of them through the private funds.
Got it. What is the state of private markets in China right now?
Very challenged. So the reason why we built the ETF was specifically to take advantage of what we thought were irrationally depressed valuations, and again, this information arbitrage on the public side. The private side is in many ways much less healthy, with much less light at the end of the tunnel. And that's because you had so many Western investors that has historically invested in Chinese venture capital, private equity, growth equity funds that have pulled their money from the market. A lot of it, again, for non-fundamental reasons. So not because necessarily the Chinese market was underperforming the West, although it probably was over the last 4 or 5 years, but more because they were getting pressure from their institutions, from kind of the US government basis top down, to divest from China. Particularly if it was say a public university endowment or some other kind of institution that was getting federal funding, like DARPA grants or whatever else, DOE grants, they were moving their money out of China for what I believe are largely political reasons. So what that meant is that over the last couple fundraising cycles, most Chinese private managers have failed to meet their fundraising targets, which means we're running out of dry powder on the private side in China. So again, I think that provides some pretty interesting opportunities. You're going to have a crash, and we're not seeing it, and it'll be a much quieter crash on the private funding side in China. You'll have a lot of companies that will go bankrupt, just unable to raise new funding rounds. You'll have a lot that will have to, curb their growth aspirations and just become a cash flow positive business in order to survive. There are some alternatives. So the Chinese government are putting a lot of money right now into the RMB funding side. So in China, we always had a parallel US dollar private equity market and the RMB denominated private equity market. And they had different fund managers and different LP bases. The RMB side is obviously picked up steam, but it too faces headwinds because a lot of those RMB investors were regional banks or government-owned banks, government-owned insurance companies, regional governments, and they are all, struggling right now, as we discussed. So there's less capital available there. So I actually think there are pretty interesting opportunities on the private side. They haven't yet emerged, so we'll take advantage of them when they come out to buy up Chinese private equities, maybe not the whole company, but just private secondary share purchases of very good businesses, but at significantly discounted valuations. And compounding that picture is obviously the challenge of going public. The IPO markets have been turned off in the West for years now. And actually, the biggest IPO of 2024 might end up being a Chinese company. It might be Shein going public in London, of all places, because they couldn't go public in New York. But that has compounded the pain here. And so you have, the Hong Kong stock market has been a disaster. So it's challenging to go public there and challenging to find the kind of liquidity you need. It's been harder to go public on Western exchanges because of the geopolitical environment, let alone the market in the US. So all of that is compounding to provide what I think is a very bleak picture for Chinese private equities in the short term, but should present some interesting distressed opportunities for those with dry powder.
Do you think that could have a negative impact on the Chinese economy if startups, which hire a lot of people, are unable to fund themselves and ultimately go bankrupt?
It will, but these, I think, I don't know the numbers, so I'd be talking out of school, but most of these startups are nowhere near the kind of economic impact that you would think they would be. The really big name guys are already public, and they all got public during that first wave of the cycle. So maybe some of them are laying off people. Maybe, like I say, the Tencents, Alibabas of the world are laying off people, but a lot of the tech, I don't know what the aggregate number is of employed through the tech startups, but China has always been a market that historically was more dependent on labor going into manufacturing, going into the state-owned enterprises, going into government itself. And so I think those sectors are still going to make up the bulk of jobs for new entrants. And it's the same environment we face in the West now, where people are maybe less likely to leave their job at an existing company to start a new startup in this funding environment, but the existing large-scale startups are still doing okay.
So you said you don't expect that there will be widespread consumer stimulus from the government in the same way that America handed out checks during 2020 and parts of 2021. So some aspect of the stimulus is coming from the People's Bank of China, the Chinese central bank, where they've lowered interest rates on the prime rate. What sort of other types of stimulus can we expect, or is there none coming?
It could be measures around consumer lending. So again, lowering interest rate on consumer loans, lowering the threshold for getting a consumer loan, lowering the ratio of collateral around consumer or small business loans, something like that, to pump more money into the economy through those measures. Obviously, we have, as you said, much lower inflation, but that means we also have much lower interest rates here in China. So it's a much healthier environment again today to take on debt rather than seeking some kind of equity funding for a lot of the types of activities that we're engaged with every day. I think you'll see, again, continued effort to stabilize these head name banks, head name real estate or property developers, so that there's just not this overall perception of collapse. There will be an expansion of rights. We call it the hukou system. Hukou, it's very complicated. In China, you need you basically need a working permit and almost like an ID and a visa to work in the big cities. So if you live outside the big cities, you can't just walk into Chicago one day and start working there. You need Chicago to issue a work permit to you and a living permit. So by bringing more consumers into the cities, that will help, I think, stimulate buying as well. So some of those types of measures that are a little bit more sustainable and had been, restrictive covenants around consumption, surprisingly, that they're pulling down the barriers to consumption.
Got it. And a weaker domestic currency typically is stimulative to the economy, although it is inflationary because it's you can produce goods cheaper that other countries than want. So a weaker Chinese yuan would net probably be somewhat stimulative. Do you expect the yuan to weaken?
Well, the problem we have is not the yuan side, it's the overproduction side, right? So we've got so much oversupply. The factories in China were built for a world that was just going to be consuming their products en masse. And so they ramped up production so high, and it's very hard to kind of turn that off or even to sell their existing inventory. And that's where we're seeing now stimulus that's coming up against the dumping of those products into international markets. The way the Chinese government would describe it is they've got to stimulate local consumption in order to absorb a lot of that overcapacity. So that goes back to getting China right, not getting the currency right for outbound or offshore sales. So I think they'll focus more on that, and the key is then being able to, have people buy more cars domestically, more handsets domestically, and so this goes back to lowering those barriers for domestic consumption rather than the kind of what they thought were consumer protective measures to make sure that people weren't going too deeply into debt historically.
That makes sense. And now tell us about your ETF CGRO. Is it what guidelines or rules does it have, and how might you seek to distinguish that from other ETFs or kind of the vanilla China benchmark?
Sure. We to your point about our timing, so we identified that the Chinese market was at a irrational low. So we entered at a very specific time, and we've been in the black since launch. We've obviously had some volatility, but overall we've made money, and we're up from launch, and are have performed better particularly over the last month or two from all the kind of benchmark indices or the bigger name passive managers. So our rationale for coming into the market beyond what we just felt was a clear opportunity were that we thought we could differentiate ourselves from the other names in the market. So the first was by being active. My perception is that China is a market where you have to move in and out of names and consolidate positions or be a bit more spread out, depending on the nature of the market, what the Chinese government is saying on the ground here, how consumers are reacting. This is not something where you can just buy a benchmark and go to sleep. You really need to move in and out of positions. And we do adjust probably once every week or so. So it's not day to day, not intra-session, but it's certainly on a weekly basis. We're changing our portfolio, moving out of names or concentrating into positions that we think are really starting to open up and run. So I think that active designation alone already differentiated ourselves from most of the other managers in the market. The second differentiation that we had is we're on the ground in China. Most of the guys we were shocked to find that we were competing against were sitting in London or New York or at best Hong Kong, which is a world away from Beijing. We have 30 people sitting on the ground here in Beijing, and we're listening every day again to what the Chinese government is saying in terms of where they're going to regulate, where they're going to stimulate. And to your question, I forgot to mention it before, there is kind of stimulus coming in other ways. It's not going to consumers, but the Chinese government has very clear sectors that they're very supportive of, what we would call kind of like the regulatory slipstream. Those sectors are seeing huge investment from the government. So whereas historically we might have invested in like a Chinese rocket business, and then Sequoia and Lightspeed and Matrix and other kind of global VC names would have invested into it afterwards. Today, it's the Guangzhou City Development Fund that's investing, or the Shenzhen Economic Stimulus Fund. So China government has their own investment funds through different provinces, financial institutions, whatever it is. They're investing in these tech companies that they believe to be sectorally correct. And so we need to use that on the ground treatment and constant engagement with the regulators. And we've been really effective at that. For instance, as a firm, we didn't invest into any of these companies or sectors that saw significant regulatory interventions. We weren't invested in the financial services and that peer-to-peer lending space. We weren't invested in the gaming space. We weren't invested particularly in the education technology space, which saw huge regulatory interventions. And we did so thoughtfully and systematically. We did so because we heard the regulators say they were going to be coming into those verticals. So that's kind of differentiator two. The third differentiator for us is why we use the word core values, and why why we really use kind of an American lens through which to view the Chinese market. One of the things I think that scared a lot of investors, and I mentioned it on the private side away from China, were geopolitics. And the fear that you could be investing in a company that you could be the Princeton University endowment, and one day you find out that you've invested in a manager, and that manager is invested in a Chinese defense sector business. That ultimately, if there ever were a conflict between the United States and China, that company could be making some kind of a weapon that's responsible for the deaths of American soldiers. You do not want to have that risk to be hauled out in front of the board of trustees at Princeton or wherever else about being invested in that name. Likewise, you don't want to be in any names that have any other negative noise risk around them. So maybe a clothing company that's sourcing material from Xinjiang, or that's been threatened or said that it's using slave labor, or some other kind of risks. So what we did as our third differentiator, and we realized this again because we looked at some of our competitors and we noticed that they had names in their portfolio that were on blacklists in Washington, on gray lists, on white lists, watch lists. And we're also spending a huge amount of time in Washington talking to people on both sides of the political aisle, and to the committees, and to the different ministries, I guess you call them, but the commerce guys, or the whatever, and understanding where are they going to be regulating, what sectors are they going to be coming down hard on, what names specifically. And then we're usually 6-12 months ahead of time in terms of getting out of those names or steering clear of them. And so we engaged what we call our political risk board, and those are composed of ex-military officials, congressmen, members of different government agencies in America. And then we use them to kind of filter our names and look at, like an example would be a name that on the surface looks okay, but when you dig down 4 or 5 layers, you see that they're using their geospatial data to aid the PLA, the Chinese military, or there's some other, they've been accused of using that technology in Xinjiang or something like that. So we're filtering our names 4 layers down to ensure, if at all possible, that they're not infringing upon both American national security nor American values. And so the way we look at it is we're outperforming our competitors on kind of just performance, but we're also kind of doing well by doing good, in the sense that we are not investing in names that a portfolio manager or an RIA is going to be hauled out in front of their constituents or investment committee because they're in those names.
And what was I going to say? Do you specifically avoid state-owned enterprises such as PetroChina, or state-owned banks in particular?
I don't think we have any state-owned enterprises in there. These are all private companies. And again, we're trying to find businesses that have as little government involvement as possible, even in terms of downstream customers.
Got it. Well, it's been very interesting getting a chance to meet you, Ben, hear your thoughts about China. Your website is benharburg.com, so people can find out all about your companies and funds there. Thank you, Ben, for coming on.
Thanks for having me.
Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.